Hello, everyone, and welcome to this masterclass hosted by Zillion and led by none other than Steve Roussey. Steve and I have known each other for 10 years or so, something like that. We actually 6-7 years, and we met while I was working at Weebly, and he's a veteran, technology veteran. He has worked in Silicon Valley for a long time in a lot of startups, and also he has invested in a lot of startups. So Steve will be sharing ideas, thoughts, gotchas, all of what he has learned over the years in investing in startups and how to really, what to look for and what to avoid, pitfalls to avoid. If you've just joined, I am recording this session and we will be sending the slides as well. So do not feel compelled to take notes or anything like that. This will be available within the next few hours on our website, the video as well as the transcript and the slides as well. Housekeeping real quick, feel free to ask questions in the chat or directly unmute yourself and ask questions. This is supposed to be a Q&A type session, so feel free to stop anytime and say, hey, this doesn't make sense, because this is new to a lot of us. We understand that. So please do not hesitate to ask questions directly. Great. So let's jump right in. I'm going to share. So Steve, why don't you give introduction about yourself and then we'll jump into the slides afterwards.
Sure. I am an engineer by trade, and but also very interested in how companies work. So I have been an entrepreneur myself. I sold the company before I started Weebly, actually, and I love working with people that are starting companies. And so I ended up creating a network of people that either were founders or were likely to be founders. My network actually ended up being quite a bit of people that became venture capitalists. So I know an unruly large number of people that have small funds. So, which is kind of an interesting little tangent, but I've used that to my advantage because it's a very interesting network for finding deals. And I've been investing probably, I guess, for about a dozen years now. And I started small and just did a few, and then I've ramped up over the years. And as money comes back, I've recycled a bit. And so I've done quite a few things in quite a few different areas, and I have more of a specialties now as I've become, more familiar.
Great. Welcome, Steve. And we counted last time Steve sent over some information. You have invested in more than 300 deals. That's pretty amazing. That's a good track record there. And I did some math, and your returns were 30% plus. I think you might still not be happy with it. I think you're still aiming for higher, but that's pretty darn good.
That's for the 40s.
You're right. Great. So let me just share the presentation. And as I said before, we will be sharing the video and the presentation with you all after the session is over. So please don't feel compelled to take notes. Don't worry about it. We got you covered. Ask questions. Please ask questions. As they pop up in your head. A little bit about me. I'm Gagan Sandhu. I started Zillion about a year and a half ago after seeing that people need a little bit of help in making financial decisions, whether it's about debt, about investments and investing in real estate, or investing in stocks or angel investing and many other things. So we are building one product at a time to help you make better decisions about all things. For instance, if you want to improve your 401k, we have a product for that digs into your 401k, helps you make great decisions with your 401k funds. if you want to track your vacation budget or any other financial goals, we have a great tool for that. If you want to buy a house, if you're renting currently, we have a great tool that helps you understand whether it's a good idea or not to buy a house. And we have also implemented AI in that, so it will actually tell you where what to look for when you're buying a house. Also, how much of an emergency fund you need in rocky times like today, where layoffs are happening and the economy is kind of dicey. How about your portfolio, right? I mean, is your stock portfolio good, too risky, not enough risk? How you can improve that? How can you invest money? So we have tools to help you make better financial decisions in all the areas of finance. Not just that, we also have experts like Steve on the platform who you can reach out to and get mentoring real time when you are actually grappling with a tough financial decision that just the tools alone cannot actually do it for you. Also, you should know your money score. If you know your credit score and don't know money score, you are losing out. So do check out your money score by logging into Zillion. Our goal is to get you to financial freedom in 10 years or less, and without having to invest more than 10 minutes a week on all things finance. So check out zillionapp.com or zillion.ai and sign up today. And with that, I'm going to pass it back to Steve.
All right, so I did sort of introduce myself a little bit and talked about the things on this slide. Coming from an engineer, we talked about how we worked at Weebly, active investor. Should just go on to the next one. So for the purposes of today's discussion, I'm going to talk about startups or these companies that are small. And they're either fast growing, quickly growing, efficiently growing, or the intention is for them to. This eliminates, a lot of other businesses, which are fine businesses. There are plenty of small businesses out there. There are a lot of things that are, where it's difficult to efficiently grow because, like, consulting business is a great example. You need to hire a consultant for, more business you have, the more consultants you need to hire, and it's really hard to, explosively grow. Software businesses are, pretty good. And so that's generally what I'm going to talk about. Now, I have invested in some companies that are a little closer to the border, where there might be consumer product goods, where I've not made the best decisions. And then there's, there's a huge number of different kinds of companies out there, which is really fascinating. When I got started, I kind of invested in a little bit, smallest check size possible, into a lot of different things. So I could see, so I could learn. And so I could also get a feeling for what I might be good at. So for today's discussion, we're going to talk about, startups, angel investors, invest in startups. And if you talk to a more traditional look at what an angel investor is, they invest directly. So you're knowing the founder, your name is on the cap table. The number of directs I've done is not 300. So it's a smaller number than that. It's in the dozens. But there is sort of a more modern take on things that you can invest in startups through intermediaries. And so you have some people that run syndicates and et cetera, and we're going to get into that soon. So a few warnings. For the most part, angel investing is for accredited investors. There are small carve-outs and the like, but by and large, the general rule is that that is for accredited investors.
Steve, let me add a little bit more context there. Accredited investor in the eyes of U.S. government or SEC is, if you are single, I think it's $1 million or 1.1 million or more in net assets. excluding your primary residence. You cannot include your primary residence. But any 401k, any stocks, any rental properties you own, if all that adds up to 1.1 million if you're single, or 2.2 million if you are if you have a partner, if you're married, that's when you reach the accredited investor threshold. Or there are other ways, I think Steve will briefly talk about, there are other ways to circumvent this a little bit. One is if you have your own business, typically you become an accredited investor. Second is if you pass an exam, it's called a Series 65 exam, you can study for it for a month, pass it, and you technically become an accredited investor through regulation. So you can either do it through assets or through regulation. Through regulation is, if you just want to get your feet wet and get started, you don't have to wait until you accumulate $2.2 million in wealth. You can start sooner. Over to you, Steve.
Yes, and then you could also use income, which a number of people do. There's an income, I think it's like 200K or 300K for a married couple.
300K for married couples for last 2 years average.
Yes. Yeah, so generally speaking, most of this is for accredited investors. It's not liquid, and be prepared for your investments to go to zero. These are you should really take these to heart, because investing in startups, you're going to have many investments that go to zero. And in fact, when I put my investments into a spreadsheet and I mark the current value, I immediately set the net present value of it to zero. So I just in my mind, I've now spent this money and it's gone. And then later I might mark it up to something else. But initially I always just set it to zero. And you'll feel much better about it if you work in that mindset.
And Steve, just out of curiosity, how many of your investments have gone to zero, actually, as a percentage of total investments?
Yeah, for me, maybe 10%, which is actually low.
Yeah,
and you might think that's a good thing. But it's actually kind of a bad thing, because I should be swinging for the fences a bit more with my investments and go for things that are more go for broke or die trying. So my failure rate's low. It is increasing this last year as companies have a hard time raising money, or their business model is not working out, and they're not getting the extra runway to figure out how they're going to survive. So,
and what's the industry average? What percentage of investments typically go to zero?
I mean, if you look at just startups or all small businesses and things, it's 95% go to zero. So it's probably a nice thing to think of. 95% going to go to zero. Now it's your job to try to find the ones that don't go to zero, and the ones that do really well, but not be so risk adverse that you don't get the big winners. Because the big winners, as we'll talk about in a little bit, matter more than anything. Companies that fold when you have a portfolio, it's sad, and no one likes to lose money, and the entrepreneurs that are working don't want to shut their company down, and the whole thing is terrible. But from a portfolio point of view, it's also expected. So it's mindset for this is extremely important, and you do not want to be that investor that is yelling at an entrepreneur because the company failed. I mean, the entrepreneur feels it more deeply than anyone else is going to.
Yeah, as a founder, I can attest.
Yes.
I'm way more invested in my business than any investor who would be. So yes. And the last point you're saying, aim for, this is an important point. Never invest more than 10% of your net worth in startups. I think you are even more conservative. You're saying not more than 5
Yeah,
to 7%.
I would go onto the higher side if you are doing like a lot of direct investments, and you're which require, a larger checks sometimes. If you are at the point where you're spending, if you're spending 12 hours a week, looking through, and you've got like hundreds of startups per year, maybe 1,000 startups a year that you're looking at, and you're investing in a certain percentage of those, you could go higher. But if you are just getting started, I would start at a lower amount. We'll talk about some of the psychology of like
Sure.
deciding on a company a little bit later, but you could easily spend, there's enough out there, you could spend all your money very quickly. So, and you can write larger checks for any of them. So, so you don't have an infinite well. You would need an infinite well to invest in everything.
Makes sense. Great. If you're just joining, welcome. Please note that we will be sharing the video as well as the presentation after we are done. So if you missed the initial part, don't worry, you can always catch up later.
Yes, so here we go. Ways to invest. Your typical angel investor is what I refer to here as a direct investor. The SEC regulation for that is Reg D. That's what requires accredited investors. Do your own diligence. You do your diligence on the company and everything about it, market, etc. You're going to be doing your diligence on the founders. And then when you're going direct, like it's kind of a partnership. You want to really help these companies, and this is true across all of them. You really want to help them succeed. And so, you're mentoring, and you're going to have a lot of interaction with the founders, making introductions, etc. I've been able over the years, what the minimum amount is very much dependent on the founder. So I typically 25,000 is a minimum. I've got myself in at 10 on a few. Generally, I already knew the people, and it depended on what my financial statement was at the time. These numbers, depending on which round it is, could go into hundreds of thousands or more. But I think when you're getting started, if you put your mind on 25K, if you're doing direct things, but if you're doing that, you're going to want to do at least 25 companies or 50. So take whatever amount over a certain number of years that you want to invest in, say 4 years, and then take that total amount, divide it by somewhere between 25 and 50 companies you want to invest in, and then that's going to be your amount. If that amount ends up being, too low to do this, then there are some other ways of going about it. So the next I have up here is Reg. Reg is regulation from the SEC. Reg crowdfunding, which was put in the Jobs Act many years ago, being able to get people to invest in companies, startups when they're really early. And then it's followed up by Reg A and Reg A plus. Reg crowdfunding a company could raise like up to 2 million. Reg A now, I think you could raise up to 20 million, and Reg A plus, you could raise up to 50 million. And so now you could actually raise some real amounts on there. The dynamics, and you don't need to be an accredited investor, so anyone could do it. And so there are portals that allow that basically, if for Reg crowdfunding, Reg A plus, you have to go through what's called a portal. So it's a third party that does some vetting on the company and the like. You still got to do your own research, make your own decisions. You're not gonna truly have direct access to founders unless you invest directly. Sometimes the third parties will set up something for you, for a whole group of investors to interact with the founders. And they'll generally do that during the investment period, but not on an ongoing basis. And your information rights from here on out are going to be much smaller. You're going to get far less information about the company as it proceeds, except with the crowdfunding, Reg A plus, because it's not accredited investors, the government does require certain amount of like quarterly filings, like you're a public company in a way, but they're very, very reduced. I actually think like all companies, even if they're not doing Reg J crowdfunding, they should probably update their investors in a similar fashion. But they do not. Certainly not with financials in that kind of detail. So the Reg crowdfunding and the like, you could like start off really low. Of course, whoever the company is going to set up what the minimums are. And going to find that across the board. Somebody's going to decide on minimums. The great thing about this is that you could just go start looking at what startups are available in this class and read all the materials and start getting familiar with information that they would have. So one of the ways to just start thinking about it is you can go look at all the people doing these crowdfunding Reg A things, read all the things and think about which ones you might invest in. The numbers are small enough, you could just invest in things to see like how your decisions are without putting a lot of capital in it, just to like track for yourself. The types of companies that use crowdfunding and Reg A and Reg B are not always the they're a little different bent. They tend to be more consumer, and so they're getting their customers that they already have to become investors. It ends up being like a really big push, because if you love a company really well and it's and you're an investor, you could become an investor, right? And so you tend to have companies that have that kind of customer base go this route, because it allows anyone that's a customer to invest. Now, I also know some big name people. Bill Gross started a solar company. I invested in it because it's Bill Gross. He did a Reg A, maybe it was a Reg A plus. He went public via a SPAC. 2 years later, I got a 25x return. So I have invested in a few of these.
I think there was a question
Sure.
on what platforms, the question is, for direct funding, other than knowing a founder personally, how else can you go about it? And I've tried to answer it. So we will go through this later. And Steve mentioned there are portals. AngelList.com is one. I think Republic is another one. There is EquityZen, but we are going to cover them in the later part of the conversation. And we will also provide you a link so that you can easily navigate those and get started. One thing I would say is, there is a lot of jargon here. I think everyone should start exploring it early. If you wait, hey, I can't invest until I have X million dollars or something, I think then the learnings start later. So it's important to get started and find your niche. And investing in startups is all about finding your own niche and what you specialize in, what you have an eye for. And I think that you can't wait till you are 50 to start that. I think you should start when you're in your late 20s or early 30s.
Yeah, you definitely start your learning. And at the very end, I have some suggestions for books. I actually had like 5, but I've narrowed it down to 2. And so I think those 2 are sufficient. And I'll get to why on each of those, at the end. On the question of direct, though, how do you find the companies? That's called deal flow. And each individual kind of has their own way, and that's your proprietary deal flow. And so that comes from your network. So that's your friends, your associates at work, other people you might invest with that share deals. That's how a lot of it gets done. Nowadays, there's things like demo days, YC has a demo day. Every accelerator has a demo day. There's like 1,000 accelerators out there, so there's 1,000 demo days. Every university has demo days. There are all sorts of things. And once you start investing in some people, founders are going to be the founders that you invest in are going to probably be your best source of who else to invest in. And so you should really like make those relationships work. On the reverse is also true. If you're a founder trying to find an investor, your best bet is to go through somebody that's already raised money, and then become acquaintances and friends with other founders that are one stage beyond where you are, because they've already done the raise. And when it comes from referrals, a founder referral is the best. And fellow investor referrals are really just sort of so-so in comparison. Now, really quickly, I want to get through a slide before too long. There's SPV via syndicate. Now, this is a way to invest in a single company. Also, this is go back. There's a lot of ways this happens. I'll talk about how you can do this via portals, but this is something that happens in portals in high volume. It also pretty much every venture firm tends to also create SPVs for what they consider some of their winners when their companies go to invest more money later. Sometimes the venture capitalist doesn't have enough cash available to invest in the next round, but they have the right to invest in the next round. They don't want to give it up. So they go and find other investors. Usually they're their own investors, but they'll go to a wider range of investors in order to like not give up that that right to invest in the nenext round. So I'll talk about some of the portals for that in a little bit, but SPV, by the way, special purpose vehicle. That's LLC created for the sole intention to invest in one thing. So they're investing in one company. All the names of the investors that they pull together for this end up as one line in that company's cap table. Now even crowdfunding and Reg A are using SPVs to do their investments. They didn't used to, but they do now. I say via syndicate. So the people that syndicate these deals are called syndicators. And some of them are registered on portals. Some of them are private, and you just got to find out who they are and get to know them. And some of the portals really sort of promote some of their favorite syndicators. And again, I'll list the portals at a little bit later. One thing to note, though, this is very much sell side. So not only is the company sort of pitching, but the syndicator also has, they're going to make money too. So they're going to try to sell you. So they're going to come with a deal memo that's going to be very hyped up. And then, it'll also have, you'll have the deck and stuff from the original founders, which also hype things up. You need to like pull some of the emotion out and decide, is this like something you want to invest in? Once you read enough of these deal memos, you'll get a feel for how that works. And that's why I recommend you start now and at least start reading and becoming familiar with the terms and what looks right. And then when something doesn't look right, you know that it's kind of out of bounds. The next two things are funds. This is basically you, like, I don't want to spend all these hours investigating all these companies and the markets and all this other stuff. I'm going to invest in a fund. It's professional. I'm going to invest in a venture capitalist. There are tons of very small funds, and I know lots, maybe 100 or 200 people that do this. They're called emerging managers because it's their first funds, and the first funds are usually small, and the first funds tend to do pretty well. So you could invest in funds. That's a little more difficult to find out who those people are. There are rules for and against people that that promote it. So you can find some funds at a place, some of these portals like AngelList. There's a few more portals I'll mention later. And then but usually the funds are kind of specific. They're like, I'm doing climate change in the United States, or I'm doing fintech in South America. You also have fund of funds. These are funds that invest in other funds. So this is like an index fund, if there ever was one. And you get a broad exposure to the whole category. So, but there are, you definitely, I mark here as a qualified purchasers, generally speaking, is true. There's some exemptions. I am not an official investment advisor, so do your diligence. I'm not an attorney, talk to your attorney. But generally speaking, to invest in fund of funds, you typically need to have a higher than accredited investor level of wealth.
Is it like 5 million net worth?
Yeah,
something like that?
It's 5 million instead of 1.
Yeah.
Also not including your house, etc. And the minimums tend to be higher. If you know people, then you might be able to get lower, but they tend to be higher. Those are even more opaque and difficult to know about. I have some friends that at one called Decile Capital, and I think they just closed one, so they're not raising, so I can talk about it. And so you can reach out to me on Zillion to get an introduction to them if you want to do an investment into fund of funds. They have a great group of emerging managers that they bundle together in one investment.
One quick thing I would like to add, Steve, thank you. This is a lot of detail. One thing to note that we haven't mentioned here is the time investment. I think the time investment declines as you go further down. If you are investing in fund of funds, you don't need to worry about anything. You just write a check and forget about it. And you expect the professional, let's say I'm just making it up, but let's say you are investing in Sequoia's fund of funds or Bain Capital's fund of funds. You don't need to worry about it. You just sit back. Even if you invest in a fund, let's say there's an emerging GP that you like and they are based in an area that you like and they invest in an industry you like, you basically sit back. You just wait for them to send quarterly or yearly updates, and that's it. So the time investment is minimal at the bottom, but if you are going to invest yourself, the time investment is substantial. You should keep that in mind. So, whatever value you put on your time, make sure, that's why VCs it's a full-time job. You have to invest in 2 companies, you need to talk to 200. That takes time. Yes,
if you're going to invest in 1 in 50, 1 in 100, 1 in 200 companies, because you're going to look at that many before you find one that you want to invest in. And I look at, I look at probably 3,000-4,000 a year, and so not everyone could do that. And it takes a lot of, that's a lot of decks to read. I read decks so quickly these days. But yes, so if you don't want to put in the time, then the ones at the bottom are probably the best bet for you. And then
one thing, what I do is because I'm in tech, every so often I come across a product that I'm like, oh, this is an interesting product. I would like to use it in my personal life or professional life. And it's a delightful product. So what I do is I go to Equities In and I buy shares of, and typically these are bigger companies, like, Patreon is one. I liked what they do and I like the mission and all that. So I went to Equities In and I bought some pre-IPO shares. This is not technically, Patreon is not a startup anymore, but it's not a public company either. So that's one way you can do it. So instead of looking at thousands and investing in few, what you can also do is every so often when you hear about a good product, a good company, you can scout for that company in the wild and say, hey, how can I buy a slice of that company? Either directly investing in them or investing through an SPV or buying shares off of what's called secondary market on something like Equity Zen or something. Again, it depends how much time you have.
Yes, yes, and I've done secondaries also. I knew someone at Palantir in the early days, and so I had secondaries in Palantir, which I had to hold on to until they went public. They went public in a direct listing, which was nice because you could like sell off 20% right then. And then you have your lockup and wait the 6 months for the rest of it. But yes, and when we get to the next slide, I do mention some what do you call it? Secondaries marketplaces like Forge Global, Equity Zen, etc. For funds, there's a few others. It's relatively new space. I happen to be an investor in some of these down here, so I got to promote them, but it is very much a new space, and it's we're gonna see how it works out because, like I said, funds and fund of funds are pretty opaque products that there are various rules about marketing a fund or a fund of funds to non-accredited investors, or if you do, then you have a whole different set of rules to follow. So, and a lot of people don't want to follow those particular rules, and so which makes them even more difficult to find out who those people are. So some of these portals are also sort of accredited or more gate locked, so you don't have to worry about doing that. So on the crowdfunding, RedJ, you have WeFunder, Start Engine, Republic, Seed Invest. There's a whole bunch. Accredited investor ones. There's Angel List, Our Crowd, Forge Global, Equity Zen. The funds, the Eki, Prometheus, Velvet, Pulse Access. There's a few out there. They're all fairly new, I'd say, in the last 2 years. And I have been creating a list of these, which I've been updating quite a bit lately. And so there's a link here for embark.com/capital/portal, just in case you're only listening. That's embark with a C.com /capital/portal. And so I'm pulling a lot of data that I just have in my spreadsheets that I'm putting on this website. And then also most of the website is pulled from the SEC database, which I happen to have a local copy of that I update on a daily basis. And I've generated a bunch of stuff. And so not everything I use personally is on this website, but eventually I'll have like most of the tools I use in a nicer form for other people to use. And it's just a free website, just mostly public data anyhow, just reconfigured in a more useful way.
And the engineer in you can't
help it.
Do that.
I had to I wanted to learn a few new technologies, and I was like, oh well, and I've wanted a copy of the Edgar database from the SEC, and so I could slice and dice some stuff, and the two merged and created a website for it.
Great.
Now this is probably one of the more important things, and it's
Steve, time check. We are at 45 past the hour, so we might have to
go quickly.
Yeah, go a little bit quickly.
Yeah, so I'll go quickly on this, but portfolio theory.
I didn't get that.
Oops, Siri's talking. Basically, what you're doing when you're investing in startups is that you are looking to invest in a company that will return 100x on your money. And so if you think about it, let's say you invest in 25 companies and one of them returns 100x, then you have, if you invested $1 in each of those 25, you spent $25 and one company gives you 100x. So now you have $100, that's 4x from your original investment, assuming all the 24 others go to zero. And that's how you end up getting a nice 4x over a certain number of years portfolio. Any of those 25 that don't go to zero just kind of helps the number go up higher. But if you have a bunch, you're still going to have, just assume, 60% go to zero. Then there's no other way for you to get your money back unless some of them are just extremely large returns. You cannot invest with the idea that your company is going to return 3x, because too many of them are going to fail and go to 0x. That the 3x company is not going to return the amount of money you need to make the portfolio of companies work. And that's why you need to figure out how much you're going to invest and divide it out, and make sure you invest in at least 25, maybe 50 companies. I would go for 50 over a certain period of time. Anyhow, that's probably the most important thing. Companies go to zero, and you need to find companies that will return 100x. And that's the most. Those are the two. Those are the two parts of the finance. The other things, you could figure out what your multiples are afterwards and what your internal rate of return is, and etc. But this is the most important thing: is you got to invest in companies that are going to return 100x, and you got to be okay with the fact that companies are going to go to zero. There are some people that will disagree with me on this. The time really kind of tells that it's just so hard. So many companies go to zero or to 1x that this is the only way to actually make a decent return.
And maybe Steve, you will. One thing I would mention in this is investing in startups is hard. That's why very few people do it. If it was easy, everybody would be doing it. But one thing I'm very almost adamant about is you should invest in what you know. And that's why even in VCs, you will see, hey, some VC will say, I only invest in consumer tech in the US, right? Because it's impossible to invest everywhere all the time. So I would say whatever industry you are working on, where your interests and your experience intersect, that's a good place for you to look for. Let's say I'm just making it up. Let's say you've worked in tech industry in the US. Look for tech in the US. And let's say that tech industry is specifically serving banking. Well, now you know a lot about banking in the US served by tech. That's something you should focus on and look for. And maybe you'll find, hey, there are 200 or 300 startups. Now you have narrowed it down. So you're not out in the wild. You're actually looking for something very specific, and you will have a likely higher chance of finding something because of your knowledge, because of your own expertise.
In addition, when you're doing your direct investments, they want people that can add value besides the money that you're putting in. So if you're familiar with that space, then you can help them. And that goes to the sort of mentoring and making introductions and the like. Now, I've made introductions for people that I invested a small amount through a third party. And I was like, oh, they really need to talk to this other company over here. And I'll reach through and make the introductions because I know it's going to really help their business. And there's this part of the reason why startups sometimes use syndicates, because they can use that whole group of syndicates connections. And generally when they're sending out updates, there'll be an update from each company that talks about what their needs are. Which is definitely something you should be looking at so you can help in any way that you can. Now, the other thing is, like, you think biotech's going to be like really hot in the next decade and you know nothing about it, probably a good place to invest in a fund.
Yeah. In the trend, if you want to invest in the broad industry trends, economic trends, you can be wrong. Yeah, you don't have to be right, precisely right. You can be directionally right.
Yes.
I think we covered a lot of the stuff that's on this slide.
Yes. We have. I think we can move on to the next. This is goes a little bit of psychology of things, and tend to fall into one of these two buckets. Either it's hard saying no, every deal looks amazing, and the founders or the syndicate lead is like super excited about it, and you want to invest in everything, or you don't want to say no to friends, and you don't want to miss out on the really good investment that's going to do the 100x. And so you find it hard to say no, and you want to say yes and put your money in everything. Pretty soon you don't have any money left. Maybe you didn't diversify over time, which is also important. And so, these are some of the pitfalls. You could also have the other problem, which is like you might fall into, it's hard to say yes and you never invest in anything. Because saying yes to strangers, which founders are strangers a lot of times. They could be your friends, but once you get past that group, not every friend of yours is creating a new company every year. So you're going to end up with like people that you don't know so well, and then handing them over your hard-earned cash could be a difficult thing. And so you'd be hard saying yes, and you don't get enough to get to a full portfolio where the portfolio theory stuff works. So these are some of the psychological pitfalls that you're probably going to run into, and you need to like push yourself past. I wanted to add valuations. This is pretty much the last slide. Very hard to get 100x on your money if the starter's starting at 100 million, right? So you need to buy low and sell high. Such a basic, but to do it right, you need to buy low and sell high. Don't forget to sell high. And a lot of people in this case, the selling high is the company gets acquired or IPOs or something, and so it's sometimes out of your control, which makes it kind of easier on the sell high part for doing this kind of investment. If you invest early, every investor after you is going to add some dilution. There also should be increasing the value of the company over time, but it's the more a company gets investment, the more diluted you're going to get. So if the company's capital efficient, you're much more likely to get your 100x. If it's something that requires tons of capital, it's going to be a lot more difficult. And that's why the valuations on some companies are different. Some hard tech companies might require like huge sums of money that might be equity, in which case there's going to be a huge amount of dilution. Same with consumer products, where there's going to be lots of dilution because they require lots of money. And then their multiples are different. In the slide, I give an example of a company. By the way, don't spend the money on your winners before you get it, because like I had a winner. I invested at 6 million, was up like not counting dilution, it was up 200x. Realistically, there's lots of dilution. It was maybe 50x. They went public at like a 1.2 billion valuation. Awesome. By the time today it's worth a little bit more, but it dropped down to like 30 million, and they're doing hundreds of millions of dollars a year in revenue. But the company, like, just consumer product stuff, not so popular on the stock market, and it dropped like a rock. And you get locked up. You can't sell at the very beginning. Usually, I've had some great cases where I could, And so, it ends up not being this big win that I thought it was going to be. And I hear some people like get loans on these big winners.
Oh,
Yeah, I do not recommend it.
yeah.
So unless you are making the loan, the only thing grabbable is the stock in the company itself. This is not an area that debt is a useful thing.
Cool.
So,
In the interest of time, these are the books that Steve has mentioned.
yes,
Time.
Angel is about angel investing, so it's like the most obvious thing to read. Venture deals tells you a lot about the mechanics of how stuff works, and really lets you know, I think, the vocabulary, and is probably one of the most insightful books on like how startup mechanics works from a fundraising point of view.
Also, you can follow Steve on Zillion and ask him questions. You can chat with him like, hey, Steve, I'm thinking about investing in this new, shaving club thing. Should I invest or not? And he'll be happy to share his thoughts with you. Lastly, you can, try Zillion for free at zillionapp.com. Some of you are already customers, so thank you. There is one question, Steve, on what should be the exit strategy. I'm going to stop sharing my screen, but any thoughts on that?
Yeah, so like I said, these are long-term investments, and so you should expect that you'll be in them for at least 10 years, if not longer. And your choices are limited. So if you are going through a third party, the third party generally decides when you exit. And so you don't really have a lot of choice on that. If you are going direct, I do recommend that, like, if you hit a certain thing like 50x or even 20x, your opportunity to sell is generally when they're raising their next round. And you can sell sometimes to the next investor that's coming in on the next round. Generally, you would want to wait like a few rounds. So if you're investing at seed, you might wait till like Series C comes around, and you're like, hey, I just take some of the money off the table. I'm a seed investor, right? And you'll have some opportunities. It very much depends on what the founders think, what the new investors think. This is not
no guarantees.
Not a liquid market.
Yeah. I think a fair way to think about it is if you invest money in startup, 10 plus years. That's the way to think about
these
it.
days.
Yeah, 12. And yeah, if you hit a
That's
recession, right now the markets are frozen. Nobody's IPOing. So, and the other thing to know is you don't have any control over it. You might want to see the money. You might need the money, but who decides when to go public or when to get acquired is outside your control. So keep that in mind. This is absolutely illiquid for 10 years.
Yes. This is what they call patient capital. So if you need to be patient.
Any other questions?
It's not crypto.
Anything else that you wanted to ask? We have Steve. He has seen it all. What other questions can we answer? And also, I have invested in about 20 companies or so, some as a direct investor, but most as buying off secondaries or buying as, like investing as part of SPVs, and one fund of funds, or a fund, not a fund of funds.
Yes, I like funds. Funds are good. I used to not, and now that I appreciate what they do, and so I like funds. Fund of funds. It's great.
Great. Thank you so much, everyone, for attending. This was great. Thank you for all the questions. And we will share the video and the presentation in the next few hours. If you have other questions, you can always reach out to me, gagan@zillion.co. Steve, you can reach out to him. Just sign up to Zillion and you'll find him there.
I'm on the app.
All right. Thank you, everyone.
All right. Take care.
Bye. Thank you so much, Steve.
You're welcome.